Welcome back. We will be covering Chapter 6 today, which is completing the accounting cycle. And this will be covering the last step of the accounting cycle, which will provide you a complete picture of the foundation of accounting principles that you will need to learn throughout the semester. At the end of the accounting period, a business usually prepares the accounts so that they can be ready for the next accounting period. And so, preparing the accounts, the process of preparing those accounts to be ready for the next accounting period is known as closing the books. And to close the books, it is necessary to distinguish between temporary and permanent accounts. Temporary accounts relate only to a given accounting period, and a business must close all temporary accounts at the end of the accounting period. They include all income statement accounts and the owner's drawing accounts. In other words, we must close all of the revenue accounts, all of the expense accounts, and the owner's drawing accounts. Permanent accounts, on the other hand, relate to one or more future accounting periods. So permanent accounts are not closed from period to period, only temporary accounts. Instead, what we do is the business carries forward the balance of permanent accounts into the next accounting period where it rolls it over. And permanent accounts consists of all the balance sheet accounts, including the owner's capital account. So, in other words, we don't have to close the asset accounts or the liability accounts and the owner's capital account. So, how do we close the books? We do this by recording closing entries or journalizing closing entries. So, what a business has to do at the end of the accounting period is transfer temporary accounts and their balances to the permanent owner's capital account by recording closing entries. And so we do this by following these 4 steps, which is the first step is debiting each revenue account for its balance and crediting income summary for total revenues. Then the next step is to debit income summary for total expenses and credit each expense account for its balance. The third step is to debit income summary and credit owner's capital for the amount of net income. And the fourth step is to debit owner's capital for the balance in the owner's drawing account and credit the owner's drawings for the same amount. And so what I'm going to be doing is showing you an example that would walk you through these 4 steps. So to illustrate this, here we have balances for temporary accounts. Remember that we only close temporary accounts, which consists of all revenue accounts, all expense accounts, and the owner's drawing account. So this gives you a balance for each of those accounts that are temporary that we must close. So if we follow the steps that I presented to you in the earlier slides, our first step is to debit each revenue account for its balance. In this case, we have a balance in the revenue account for $15,000. So what we do is we record the journal transaction as in by debiting $15,000 in our revenue account. And then step 1 also tells us that we must credit the income summary for total revenues. So in this case, we need to credit the income summary by $15,000. Notice that this is a new account that we are using, and we only use it when we're closing the books. So let me say that again. Step 1, we need to debit each revenue account for its balance and credit the income summary for total revenues. So if we look at all of the revenue accounts in this example, we have one. That's the revenue account for $15,000. So we debit that. Remember, we always debit first. And we debit the revenue account for $15,000. And then we credit the income summary for total revenues. And when we credit, we indent. We write it down as an income summary for the account title, and we credit that by $15,000. And then we add a simple description to identify the reasons for this transaction. In this case, it's to close the revenue account, and we are done with the step. So this is the first of 4 steps to closing the books. The second step is to debit the income summary account for the amount of total expenses. So in this example, we have 2 expense accounts. We have the salaries and wages expenses and the rent expenses. And both of these expenses total $12,000. We have $10,000 for salaries and wages and $2,000 for rent expenses. Therefore, what we have to do is debit the income summary account for $12,000. Okay? And then, according to the instructions, we need to credit each expense account for its balance. Notice that it is each account, not the total of expenses. So since we have 2 expense accounts here in this example, we are going to have 2 credit lines journalized in our entry. So we will credit, remember we indent for credit, we credit the salaries and wages expenses for $10,000, and we credit rent expenses for $2,000. And last, we add a brief description to describe the reason for this transaction, which in this case is to close expense accounts. The third step is to debit income summary and credit owner's capital for the amount of net income. So first of all, we need to remember what is net income. Remember that net income is determined by determining the revenues and deducting the expenses from the revenues. So in this case, we know that for this accounting period, the revenue for this accounting period accounted or totaled $15,000. And we know that the expenses amount to $12,000. So to determine the net income, we subtract, in this case, revenues minus expenses, or $15,000 minus $12,000, to determine the net income to be $3,000. So to complete this step, we determine the net income, which we just found out is $3,000 for this case. And then we debit income summary and credit owner's capital for the same amount. So we debit income summary for $3,000 and we credit owner's capital for $3,000. And then we add a description for this transaction, which in this case is to close net income. But also please remember that if we have more expenses than revenues for the accounting period, then we will not have net income. In this case, we would have a net loss. So if it's a net loss, then we make sure that the description says net loss, okay? In this case, I just put it to close net income or / loss, depending on your example. But for this example, it's net income. The final step, or the last step, is to debit owner's capital for the balance in the owner's drawing account and credit owner's drawing for the same amount. So the balance in the owner's drawing account is $1,000. So we debit owner's capital for $1,000, and then we credit owner's drawings for the same amount, so $1,000. And lastly, we add a description for that transaction, which in this case is to close drawings. Once all of the closing entries have been recorded, we can prepare another trial balance, which you have learned to do in the past. And this time, what we're going to call that trial balance is for posting the closing trial balance. So we call it post-closing trial balance, and it's coming from the ledger. So this post-closing trial balance lists permanent accounts. Permanent. Make sure you get that term. It's permanent, not the temporary accounts. And you have to take their balances. So again, to post closing trial balance, you list the permanent accounts and their balances after the journalizing and posting of closing entries. And remember that the permanent accounts include all asset accounts, all liability accounts, and the owner's capital account. And once those balances are recorded, make sure that you check that the debit and the credit columns are balanced. And if they're not balanced, that means that something is wrong. This accounts for the last step in the accounting cycle. That's it. That's all you do for closing the books. You just follow those 4 simple little steps. And believe it or not, you have covered all of these steps, all of the accounting cycle steps in the last 6 chapters. So you learned, first of all, to analyze business transactions, which consisted of determining the accounts that are affected by the scenario that the accountant is facing. And you determine, in other words, which accounts are affected within the accounting equation. And once you have analyzed a transaction, you journalize a transaction, which is recording the transaction with the name of the account affected, and is either debited or credited, depending if the account is increasing or decreasing based on the scenario. Then you post to the ledger accounts, which is transferring all the transactions for a particular account in one place. Remember, you have the general journal, which is like your main transaction record, but that has all of the accounts, whether it's for assets or liabilities or owner's equity, which can become very messy and very long. So you learned how to post to ledger accounts, or separating those transactions and based on categories. So you had all the transactions for assets in one place, or for example for cash and for equipment and supplies, and then you had it separated also by liability, so accounts payable, and then you also separated all the accounts into all of the transactions that dealt with owner's drawings or owner's equities or revenue and expenses into each of those accounts. And then you prepared a trial balance, which is transferring the balances of each account that you posted in the ledger accounts in one place, and then making sure that the debit and the credit columns are balanced. Then you journalized any adjusting entries, and then you prepared the adjusted trial balance to make sure that the debit and credit columns are balanced. You then prepare financial statements, which included the income statement, the owner's equity statement, and the balance sheet. And then the last two steps that you just learned is journalizing the closing entries and preparing a post-closing trial balance to make sure that the debit and the credit side are balanced. And that's the accounting cycle, which is the foundation of accounting. And these steps are going to be used over and over and over again as you learn new accounting concepts in relation to different business transactions. Like in the future, in this semester, you will learn about payroll and taxes, but essentially, you will be learning bits and pieces that are new to the accounting world, but always referring back to this accounting cycle. So it's very, very important that you feel very strongly and sure that you know this accounting cycle pretty well, which is the reason why I have focused on each of these steps a week at a time, and why it has taken us a little bit of time to cover the accounting cycle. I wanted to make sure that you grasped the concepts strongly before we move on to the other concepts in accounting, which we'll start covering more quickly than before. We'll probably cover, a few concepts at a time versus concentrating one concept per week. And that is it for this chapter. So if you have any questions, please let me know. Contact me by email or by phone. And don't forget to complete your homework assignments for this week. And good luck to you. Thank you for your time.